So in this video today, we are going to be talking about 6 high-yielding dividend stocks that you may want to consider investing in as a dividend investor looking for income from their portfolio right now. And if you guys aren't familiar, I started this process of building up a $100,000 dividend stock portfolio at the beginning of this year for the purpose of earning passive income, reinvesting those dividends to earn compound interest, and essentially allowing my money to grow without really actively involving myself or funneling more money into that portfolio if I choose not to. And at a time like this, during market uncertainty, a lot of people like this idea of dividend investing and being able to earn those quarterly or annual dividends or biannual dividends from their investments. But the one thing you have to watch out for is something called a dividend yield trap. I did a whole video on this the other day. I'll put it up in the corner if you guys want to check it out. And that is where people will solely invest in a dividend stock based on a high dividend yield. And the problem is that dividends can be cut, eliminated, restructured at any point in time. So you can't just look at the dividend yield and pick the stocks on the S&P 500 with the highest yields, because those dividends could be at risk for a cut or worse, a suspension. So instead of just looking at the dividend yield with these stocks, we're also going to look at the dividend payout ratio, which tells you how much of the company earnings are currently being paid out in the form of dividends. And we're also going to be looking at the dividend growth streak as far as how many years this company has consecutively grown that dividend, because the longer that growth streak is, the more likely a company is going to continue paying that dividend rather than disrupting it and breaking that streak. And before we get into the picks here, guys, I just have to say, this is just my opinion. This is not any kind of financial advice, and you should always do your own due diligence before investing in the stock market. But that being said, guys, my number one high-yielding dividend pick right now is 3M. It is a dividend aristocrat, which means this company has been growing dividends consecutively for 25 years or more, and they have in fact been growing that dividend for 61 years consecutively. Now, as we go through these, I'm going to give these a rating out of 5 as far as my opinion on the likelihood of that dividend being safe for the near future. And I'm going to give 3M a 5 out of 5. They currently have a payout ratio of 73%, so they can easily afford that dividend. It currently pays a dividend yield of 4.05%, which isn't necessarily, sky high, but again, we're looking for a reasonable dividend yield here as well as a high level of dividend safety, because when you get into the yields of 6, 7, 8%, that is when you have to start worrying about the safety of that dividend. As far as 3M goes, I like this company because they're diversified across thousands of different products. They serve defensive industries like healthcare, as well as cyclical industries like automotive. And so as a result, you are going to be susceptible to the ebbs and flows of the natural business cycle by owning a stock like 3M, but they are well diversified across both defensive and cyclical industries. So that is why it is my number one high yield dividend pick and a large component of my dividend stock portfolio. All right, so coming in at number 2 is another stock that I own in my portfolio, and that is IBM, and I would give this stock as well a 5 out of 5 in terms of the dividend safety for the following reasons. First of all, the dividend payout ratio is at 60%. So they have a very healthy profit margin in terms of earnings they're retaining for the company themselves, rather than distributing all earnings to shareholders. In terms of their dividend yield, it is at 5.46%, which is very appealing, and their dividend growth streak is currently at 20 years. So in just a few short years, IBM will be joining the list of dividend aristocrats, assuming nothing happens with that dividend, and based on the company and where they are at right now and the types of technologies they're involved with, I wouldn't expect them to be having any trouble in the future. Now, the reasons why I like IBM as an investment is primarily because of their involvement in cloud computing, as well as their acquisition of Red Hat, which is a enterprise-level software and cloud computing company. I think it's a tremendous business to be involved with, and IBM is currently in this position where they are shedding their legacy hardware business and building out this new cloud computing business. I think as a result, they've been largely overlooked over the last couple of years, but now I see it as a great mix of both growth potential as well as a superb high dividend yield, and I expect them to become a dividend aristocrat in the coming years. So that is why they are my number 2 pick. And then number 3, guys, is another stock I own in my portfolio. That is Walgreens Boots Alliance, another dividend aristocrat, and it is the final stock on my list. I'm giving a 5 out of 5 in terms of my opinion on the safety of that dividend. Now, Walgreens Boots Alliance currently has a payout ratio of just 46%, which indicates this dividend is very healthy and very sustainable for them. The dividend yield is currently 4.21% with a growth streak of 44 years. And in terms of the short term right now, guys, this is a company that's actually poised to do pretty well here because they are one of the only retailers that were allowed to stay open because they're involved in the retail pharmacy business, which is considered to be an essential business. So people have been going to CVS and Walgreens and grocery stores more than ever because these are the only businesses, for the most part, that have been allowed to stay open versus, other brick and mortar businesses, small businesses. Maybe before you were going to, a local store for soaps and toiletries. Well, now you're going to Walmart and Walgreens and these other stores, whether or not you like it, because that's all that's allowed to be open. So because this is an essential business, they're going to benefit here in the short term, in my opinion, or at least not be hurt as much as the other retailers out there. And going into this, guys, I believe Walgreens was trading at a very fair valuation before the economic crisis started. On top of that, beyond just owning the Walgreens stores here in the US, you also own the Boots stores in the UK, which is a beauty-related store, as well as Alliance Healthcare, which is a diversified healthcare company. So you get exposure to both the retail pharmacy business, the beauty stores, as well as a diversified healthcare company. So overall, I think it's a solid choice, solid investment, and that is why it is part of my dividend stock portfolio. It's not the highest yield out there, but in my opinion, it is a very safe dividend that I am happy to rely on. All right, guys, so my next 3 picks here are going to be higher dividend yielding stocks, but corresponding to that, there is going to be more risk there of the dividend safety and these dividends possibly being cut in the future. Every one of these stocks here has a yield above 6%. So if you're looking for a higher yield that may have more risk involved, these may be picks that you may want to consider. And also, guys, if you've enjoyed this video so far, all that I ask is that you drop a like for the YouTube algorithm, as it allows this video to be shared with more people. But anyways, guys, coming in at number 4 is a stock called Leggett Platt. You may have never heard of it before. It is basically a home furnishing fixture and appliance company, but they are a very solid dividend pick right now. And for the most part, the yield is very high because the stock has sold off massively, down about 50% from when the pandemic started. So as far as this business goes, guys, they're involved with the consumer cyclical industry, so it's not necessarily recession-proof, and that is why it is sold off. Their core businesses for them are bedding products, furniture/flooring and textile, as well as specialized products serving the aerospace industry, automotive, as well as manufacturing tools. But for the most part, they're involved in furniture, furnishings, and bedding for the home. So obviously, during a recession, if we are going into a true recession, people are going to cut down on those consumer discretionary purchases, and a company like this will make less money. But despite that, they're currently sitting here with a payout ratio of just 64%. They are a dividend aristocrat with a dividend growth streak of 48 years. So they weathered the last few recessions and crashes just fine and were able to continue growing that dividend. And they currently have a dividend yield of 6.1%. So there's a little bit more risk built in here, because this is not a recession-proof industry, but they are durable and time-tested. So I'm going to give them a safety score here of 3.5 out of 5. They'll probably be fine, but you just have to remember this is a consumer discretionary industry and their earnings are likely to fall if we are entering a recession. All right, so coming in at number 5, it is a component of the Dow, a very popular dividend stock that has been battered right now, and that is Exxon Mobil. Now, right off the bat here, let's talk about what we are looking at numbers-wise. The dividend yield is 8.6%. So a lot of people are just flocking towards the stock, thinking they're going to get a guaranteed 8.6% return every single year. And they may be right or they may be wrong. Here's the deal with Exxon Mobil, guys. The payout ratio is currently 102%, which means for every dollar the company is earning, they're paying $1.02 in dividends, and it doesn't take a mathematician to determine that that doesn't make sense and that's not sustainable long term. So Exxon Mobil has to increase their earnings to continue paying and growing their dividends, but the problem is right now, they are up against an oil crisis where oil prices have absolutely plummeted based on some feuds between the largest producing countries that produce oil. So the payout ratio is 102%, the yield is 8.6%, and their growth streak is 37 years, so they are a dividend aristocrat. But based on the current payout ratio of 102% and the oil situation, I'm giving them a safety score of 3 out of 5 in my opinion. They pretty much have a double whammy against them right now. First of all, oil prices have crashed because of the feuds, and second of all, we're involved in a global pandemic that has caused everyone to stay at home and not travel, so a lot less demand for oil for airplanes as well as passenger vehicles, all that being said. Not to mention, we are involved in a mega trend right now of the shift away from fossil fuels to renewable energies. So that is why I wouldn't buy Exxon Mobil. I personally don't believe in the long-term future of oil, but I could be totally wrong. If you believe it and you think we're still going to be using oil in 25 or 50 years, maybe you see it as a buy. It's just certainly one we had to talk about here because so many people are eyeballing Exxon Mobil and that near 9% dividend yield. And then lastly, guys, number 6 on my list here is at&t, another very popular dividend stock, and this one has my lowest safety score here. I'm putting it at about a 2.5 out of 5. And the reason behind that is because at&t currently has a payout ratio of 108%. So for every dollar of earnings that they make, they're paying out $1.08 in dividends. The current dividend yield is 6.9%. And they have a 35-year dividend growth streak, making them a dividend aristocrat. Now, the deal with at&t, guys, this company has been flashing warning for years in terms of a high payout ratio, but they have still been able to grow that dividend and pay that dividend every single year. So they haven't yet had this crisis where they've had to suspend the dividend growth or cut their dividend, but they have been unable to afford that dividend for quite some time. Now, the main reason that I just don't like at&t right now, and I've never invested in it, is because they completed a near $90 billion merger with Time Warner last year, but that involved taking on massive amounts of debt. It was mostly a debt acquisition. And I honestly just don't understand how this company has any growth potential. Maybe it has income potential, but when the customer base is pretty much saturated and they're trying to continue to grow that dividend, they're going to have to explore different avenues for revenue, and I just don't see it for at&t. However, guys, it is a very popular dividend stock. They probably are going to be fine based on how long they've grown that dividend. But because that payout ratio is so high, I think there is a risk involved here of at&t potentially having to restructure that dividend. And if they did that, that stock would go into a free fall because pretty much all at&t has had to offer people over the last couple of years is solely that dividend. There's been no asset appreciation in terms of that stock increasing in value because there's just no real growth opportunities for a company that has saturated the market like at&t has. And that leaves them in this kind of crappy situation where their only means for growth is by acquiring or gobbling up other companies, which involves taking on a large amount of debt. So it's just not really a great situation to be involved with, and personally, not a stock I would want to invest in. However, it is a very high yielding dividend stock and one that you may want to consider. But anyways, guys, that's going to wrap up this video. I hope you enjoyed it. Like I said, I started a new series at the beginning of this year, building a $100,000 dividend stock portfolio from scratch. I'll put that playlist up in the corner if you guys want to check it out. And lastly, guys, I just want to mention, in case you are interested in getting 2 free stocks, Webull is currently running a promotion where if you open a brokerage account with them, just for opening the account, you're going to get 1 free stock. And then if you fund the account with $100 or more on your initial deposit, you will get a second free stock just for funding the account. So for opening and funding an account with $100, you get 2 free stocks. If you guys want to check that out, that's going to be down in the description below. And I am affiliated with Webull, so I may earn a commission in the process. But thanks so much for watching, guys. I hope you enjoyed this video, and I will see you in the next one.